Well, welcome to this event. Again, thanks to everyone for their patience, and the special thanks, as always, to I haven't thanked them for a while because I haven't been here for a while, but special thanks certainly to FX Street for organizing this event and making it possible, and for inviting me back. I just wish my return back wasn't scarred, if you will, by my late arrival. But anyway, here I am. First, let me declare that the purpose of this event is education. I'm not going to provide specific trade alerts or recommendations, but I will provide a little bit of technical analysis and certainly my fair share of fundamental analysis. I've been known from time to time to offer my 2 pips worth in terms of fundies. Our focus today is going to be, I might take a little bit of a look back at not just what happened today, but what's happened recently. But I hope to take as much time as I can to look ahead at what's coming up for the rest of well, certainly not the rest of this week, even, but even the rest of this month, and even farther ahead, depending on how far ahead all of you want to look. I'll tell you what I'll start with. Let's start with kind of the present and work forward from there, and I'll even start with technicals and kind of work a little back from there in terms of the kind of news flow that seems to, at least in part, prompted some of today's moves. And I'll use that talk about some of the things that seem to affect today's moves or recent moves. I'll use those references as a segue for what's forthcoming for the rest of this month. Well, folks, let's get going here. Again, sorry for the delay. The point I was going to make was this. We identified in my live coaching session today, and again, what I described earlier was I'll start with some technicals right now. I'll start with a discussion of some factors that seem to move currency like the dollar, currency like the euro today, and I'll start with some current day issues, and then I'll segue from there into some stuff later this month. And I've got a whole slew of different things I can show you guys. But I want to make sure actually I'll give credit to everyone here at attending this event. You, for whatever reason, virtually all of the webinars that I do here at FX Street, the audience very participatory, arguably more so on average than our audience these days at FX Bootcamp, and some of my fellow bootcampers and even our currency coaches wouldn't like me saying that, but it's true. I mean, you guys are here at FX Street are very good at asking intelligent questions and very eager to make comments, and I specifically welcome that. So I want to let you be the guide of whatever I discuss here. But please feel free to ask questions, and I'll, as I can, we'll take some tangents here in my discussion to address those questions. Boyke's like, yeah, we are the best. So yeah, the euro we talked about I talked about in my live coaching session today at Bootcamp a 30 pip zone, between. I've got these 2 horizontal green lines on my euro chart, one at 31.15, one at 31.45. So the question is why these lines? Well, for one, let's go to a euro chart, another euro chart without indicators. And actually, the view I'm going to go to should include some euro charts. You see the euro charts. Actually, let me start with the euro charts with indicators first. I'm using a different platform other than Novian, which has a drawing tool. You should see in here a daily S2 pivot point, a horizontal green line on the hourly chart. That is a daily S2 or support pivot point, a classic bottom in a downtrending day, a classic support pivot point. On the 4-hour chart, the 4-hour chart features weekly pivot points. I have a horizontal green line near the bottom of that chart at about the same level as the daily S2. That's the weekly S2. So you have daily S2, weekly S2 pivot points. Also note on the daily chart on the far right-hand side, there's a monthly support pivot point, namely a monthly S1 pivot point just above the 1.31 handle. So you have what I described earlier in our bootcamp chat room as a what's the term I used? It wasn't a plethora of support pivots, but that's essentially what it is. a bevy or plethora of support pivots. And that's not all. That's not all. Let me show you a chart without indicators. And I'm going to show you something that many of you may have already spotted. In fact, it's featured lightly on this 5-minute chart without indicators, which I'm about to revise to a longer-term time frame and make the trend line thicker as well. Okay, there's a daily chart. You should see the lows, the early January lows on the Euro USD. You start there. You use a green trend line to connect those lows, or one of those lows, with the mid-March low. And it looks like the euro reached that green trend line today. So the combination of green trend line, at least two, arguably three major support pivot points, the basis for a long on the euro, if you decide to take it around around 31.15, around the daily S2 or the weekly S2, your choice. Well, and that's where the euro is right now, and the euro does what it often does after a notable downtrending day. As we've hit logical support, we've reached a logical profit target for the euro USD bears, so traders have taken profit. There hasn't been enough impetus, if you will, from new bears to push the euro further down. We haven't had any new news flow recently, which would have prompted any new volatility. So the euro is sort of in a consolidation phase after the earlier downtrending move. Now let's work back. What prompted this recent move down? Well, if you look at today's London session, actually let's step back further. Let's step back further than that, because I'm going to do something that's you know what? I'm going to even go look further back. I've got a chart. I want to show you folks. I may have moved it to another folder here. I had a chart marked up which I posted on our blog, and it's worth finding because I really liked what the point the chart makes. Here it is. I got it. All right. You should now see a chart in front of my. It's a chart. It's a still chart. It's not a dynamic chart. It's a still chart in front of my MT4 charts. So would someone please confirm you see this still chart? It's got some annotations on it. I refer to Bernanke, the Federal Reserve Chairman, more than once in this chart. So again, you see it, great, yeah. I refer to this chart, was it yesterday? Yesterday, on a blog post at Forex Street, where I provided a preview to yesterday's FOMC meeting minutes. Here's the point I'm making. I sense, the market's been, there's been a battle between, you can call it a battle between dollar bulls and dollar bears. And the battle line's being defined by this question: to QE or not to QE? To QE or not to QE? QE stands for quantitative easing. That's a program that's been adopted by multiple central banks, notably the Federal Reserve and the Bank of England, whereby in the past, in some cases, they're still doing this, they're acquiring government bonds. The current program being still in place from the Federal Reserve is namely called Operation Twist. The so-called Operation Twist program was announced on September 21st. It's scheduled to last through the end of June. Essentially what the Federal Reserve is doing, the Federal Reserve has some shorter-term treasury security, like 1, 2, 3-year notes, and they're swapping those. In other words, they're selling those treasury securities and using the proceeds to buy longer-term treasury securities, like 10-year notes, for example. The idea is to keep downward pressure on longer-term treasury yields. Longer-term treasury yields keeping remaining low, important to the Fed and then even to many others, because that keeps keeping longer-term interest rates down is good in terms of keeping, say, U.S. mortgage rates down. And keeping U.S. mortgage rates down helps support the hopefully an eventual recovery in the U.S. housing market. And keeping longer-term rates down also promotes borrowing and lending, or specifically borrowing, which in the hopes of the Fed, I don't know if it's maybe adding more debt to a problem which was created by too much debt to begin with. But the idea is to keep longer-term rates down to induce the kind of stimulus to the U.S. economy, which could help strengthen that economy. Anyway, so that's the idea. So the Fed has been, and other central banks, but in terms of the Fed, has been doing some so-called quantitative easing. And the question in the minds of many market players has been, what's the next step? Is the Fed going to do more quantitative easing? This, again, is so-called Operation Twist program, swapping shorter-term bonds for longer-term bonds, does end in end of June. And so the market likes to look ahead. The market likes to anticipate as soon as it can what central banks like the Fed are going to do next. Boyke, that's always the question. Boyke asked the question, what percent you give to funnies and technicals? There's plenty of days, Boyke, when it's almost entirely technicals. And then there's other days like, for example, the day here on February 29th, that day was all fundies, man, all fundies. Anyone looking to buy the euro on a day like that got clobbered. I personally believe the market is, I don't know what the percentage is, but I personally believe this current market, the market, especially last year, was a lot more sensitive to so-called fundies than what it has been so far this year. And to really boil this down, and I'll talk further about this chart you're seeing in a moment, but to boil it down, here's what we've got. Multiple central banks have done very similar things, pursued accommodative programs, easing policy, loose policy, call it what you want, low rates, unique programs providing stimulus to their respective economies. Again, the Federal Reserve's done so-called quantitative easing and recently Operation Twist. The Bank of England has an asset purchase program. The European Central Bank has not gone down the path of traditional quantitative easing, buying bonds and sterilize. What it has done, some sterilized bond purchases, which isn't full-blown QE, but what it has done, notably and uniquely different, say from the other major central banks, is the ECB has flooded the Eurozone banking system with a lot of funds via its recent LTRO program, its long-term refinancing operation, essentially cheap 3-year loans to Eurozone banks to the tune of about 1 trillion euros, and implemented in 2 phases, one in late December, the other one at the end of February. In fact, that last day in February, we thought the focus might be the demand or lack thereof for that second LTRO operation from the ECB. In other words, my question that day in our minds was, well, the Eurozone banks demand a lot more than was previously expected in terms of those ECB loans, or a lot less. And actually, the number came in as expected, a little north of 500 billion euros. That wasn't the surprise to the market that day. The surprise that day was Federal Reserve Chairman Ben Bernanke's Humphrey Hawkins testimony, which he's required by an act passed in the late 1970s to deliver to the Congress twice a year. It's sort of like an update or almost like a book report for the Federal Reserve Chairman, almost like a state of the economy, a state of central banking speech, if you will, by the Federal Reserve Chairman, in this case Bernanke, to congressmen in both chambers, the House and the Senate. And it was during that testimony, if you will, by Bernanke on that day, February 29th, which started at 10 a.m. New York time, during that testimony where Bernanke made 2 specific references, actually I should say one specific reference and a lack of another reference. Bernanke, early in his testimony on that day, February 29th, made reference to some improvements in the U.S. labor market. And the market, right or wrong, took that to mean that there's a lower probability of further quantitative easing coming from the Fed. And a lower probability of quantitative easing has sparked dollar rallies, and that's what we got over most of the first half of March. Oh, another thing that was notable in that Bernanke speech on February 29th was a lack of any explicit reference or even indirect reference to more easing forthcoming. So some like to say Bernanke sounded a little less dovish, maybe a little more hawkish that day. And in the second half of this month, second half of last month, second half of March, we got some softer than expected inflation numbers on right around on a Friday in the middle of March. That gave put the dollar back under pressure, gave the euro a bit of a spark. And then Bernanke a week ago this past Monday, Bernanke made a speech on the labor market. Bernanke hasn't made a speech in quite a while, specifically devoted to the labor market. And the reference Bernanke made then was to the idea that he spent a lot of time talking about high levels of long-term unemployment. In other words, there's an unusually high number still in the U.S. of workers who've been unemployed for long periods of time, weeks, even months. Levels of long-term unemployment are still very high here in the U.S. in spite of the recent drop in the headline number for the unemployment rate. And the question Bernanke posed was, is that a structural thing, something more that could be more permanent, or is it more of a cyclical thing that could be addressed with things like accommodative Fed policy, continued programs of easing? And Bernanke essentially said he thinks it's the latter. He thinks that easing policy by the Fed will eventually help remedy, if you will, the high level of long-term unemployment in the U.S. And right or wrong, the market took that as a hint that the Fed would eventually do some form, whatever it may be. The different forms could be different forms of future quantitative easing. Could be an extension of Operation Twist. It could be there's been seen some chatter of sterilized bond purchases in the same way that the ECB has done through their securities markets program. I've heard in some corners talk about more support for the U.S. housing market, which wouldn't shock me given the Fed's assessment in recent months of the housing market. But remember, folks, the housing market was arguably the epicenter of the financial crisis, which started in 2007, 2008, or the highlight of the crisis was then. And I can't help but notice that, I don't know if anyone else has noticed this, the Federal Reserve, the Fed in their FOMC statements of late continue to refer to the U.S. housing market as depressed. Now, I don't know about you, but depressed is a pretty strong word for a central banker. Not many central bankers refer to a market or a sector as depressed. So, that's something that that could eventually, if things don't improve materially in the U.S. housing sector, the residential housing sector that is, some think that eventually it's only a matter of time before we see the Federal Reserve acquire more mortgage-backed securities in an effort to support the housing market. In the U.S. at least, the so-called government-sponsored entities, the GSEs, Fannie Mae and Freddie Mac, they're the housing market right now. There is such a low demand for private investment in U.S. housing. That is, when I'm talking about private investment, I'm talking about in mortgages. The mortgage market is almost entirely dominated by these so-called government-sponsored entities. Sound check, testing 1, 2, 3. You guys were chatty for a while and you got quiet. I'm not saying you had to keep chatting. I just want to make sure that sound's working okay. Okay, I just want to make sure it sounds working good. So Boyke asked, what's your opinion of people who say trade what you see? Boyke, you know what? Bottom line, I do look to price action first and foremost. And in fact, I go beyond that, and I do monitor things like the commitment of traders report. I like not everyone agrees with me on this, but I like knowing what what other traders, speculators, hedge funds, for example, are thinking. Even if I think they're wrong, if I think the so-called fundies are suggesting a different story, a different theme, that maybe that something terrible is about to happen, or maybe something really good is about to happen, whatever the case. Even if I sense that, and the market hasn't figured it out yet, I will, me personally, I will still generally wait for price action and for technicals to align with that theme. I said generally, not always, but generally I will. So what I was getting at with this graphic was this. So the market's been for about the past month struggling with this idea of QE or not to QE. Is the Fed going to pursue more quantitative easing or not? Well, the current answer, the current thinking of the market, right or wrong, based particularly more recently on yesterday's FOMC meeting minutes. See, every time the Federal Open Market Committee or FOMC meets, that's the group that decides on monetary policy on behalf of the U.S. Central Bank, the Federal Reserve. About 2 weeks after the FOMC meets, it publishes the minutes of its meeting. In other words, it talks about things like, what issues were discussed, who voted what, whether Federal Reserve Chairman Ben Bernanke drank water out of his left hand or right hand, whether or not he snacked on gummy bears or pretzels. By the way, those last two things not true. That's not what the minutes cover. But the minutes do address, some of the topics that were discussed amongst the FOMC, particularly the FOMC voting members. And it also reflects, to some degree, their current assessment of the U.S. economy. And one thing I noticed from yesterday's FOMC meeting minutes for last month's FOMC meeting was that there were some reference to the prospect of a higher GDP for the U.S. Maybe the next GDP numbers coming out later this month could be better than expected. And there's some continued references to improving labor market numbers. So right or wrong, what the market has interpreted, and you can see the price action on the euro USD daily chart. Let me go to the 4-hour chart here. I mean, certainly the market has perceived, right or wrong, that there's at least a slightly lower possibility of QE, of more quantitative easing, than was previously thought. Now, that isn't the entire story today. That's probably a large part of it. Today's move down on the euro USD, today's rally in the dollar, in part an extension of yesterday's dollar rally in response to the FOMC meeting minutes, where the market interpreted, right or wrong, that there's a lower probability of more quantitative easing. The jury is still, in my opinion, still out on that. Jury totally still out on that. I still see several money managers, hedge fund managers, analysts, economists who think that it's only a matter of time before we see more easing, and maybe more easing, more quantitative easing, if it occurs, could occur after if we see a significant sell-off in equities. I mean, it's actually the so-called bond king, Bill Croce, just talked about this on CNBC some 30 or 45 minutes ago, and I had to agree with him. I don't know if anybody heard the phrase. There's in reference to the old Greenspan put. Anyone heard of a Greenspan put? The idea of a put option is this: a put option is not the right, not the obligation, but the right to sell a security when it gets below a certain level. So if price gets below a certain level, you have the right to sell a security. That's how it works, like that, right? So the idea, the label, or the phrase has been adopted to, or was coined at one time, or adapted at one time to central banking policy. The idea was this: that the Greenspan put, and that's in reference to prior Federal Reserve Chairman Alan Greenspan. The idea was this: that if and when the stock market dropped by too much, the Federal Reserve would be there to lower rates to help stimulate the economy, and specifically stimulate, you might say, the stock market. Well, now there's a perception amongst, again, many market players that there's a so-called Bernanke put in place. In other words, if U.S. stocks drop significantly, that the Fed will step in and provide more stimulative policy. Maybe it's QE, maybe some other form, whatever that. Maybe there's a new program forthcoming. So that's the mindset right now. And is that the right thing to do? Will history show that it was a smart thing to do? Maybe not. But right now the perception of the market is that, and not just the stock market, but multiple markets. You name it: stocks, bonds, currencies. The perception amongst a lot of market players is that there's a so-called Bernanke put, meaning that if stocks drop materially, like 10, especially 20%, that the Fed would step in and apply more easing. And you got to wonder in the long term, how long can central banks like the Fed play that game? But now I digress. We're talking about some deeper issues, which only history will tell how it all plays out. Yeah, GAM. I think I described that just the opposite. I think I had that wrong. But it is referred to as or has been referred to as a Greenspan put. Currently referred to as a the idea is this, that the idea is that below a certain level that something is executed. Below a certain level, something is executed. In this case, what's executed is a further easing policy by a central bank, namely the Fed in the case of the in the case of the Bernanke put, and there's the idea that could even be a so-called Draghi put as well. ECB President Mario Draghi could do as much the same thing. In fact, I thought it was interesting that Bill Gross in his interview said that Mario Draghi, ECB president, was asked about a couple weeks ago, what's the first thing Draghi thinks of when he wakes up in the morning? And Draghi's response was, "What's the stock market doing?" I thought that was interesting. Anyway, by the way, let me be clear. I am not an options expert. No, not even close to being an options expert. So, if I misrepresented that, I apologize. Or if I prompted any confusion, I apologize. So recent price action on the euro has been down. But the debate still, I think the debate is still intact, which is it going to be more QE or not QE? If the Fed were to do more quantitative easing on this year, in an election year, many think, and I tend to agree with this camp as well. Many think if the Fed's going to do more QE, it's going to happen by their late June meeting. It's going to happen by sometime early summer, because if the Fed were to wait, do the little mind experiment here. If the Fed were to wait too long and do more QE later in the year, very close to the U.S. election, it would just reek of political influence, or the Fed showing a particular political orientation, favoring the current party and power at the White House, which is the Democrats. So the Fed, one could argue the Fed may seek to avoid that, and if they see right or wrong that there's a case for more quantitative easing, which, by the way, there's still some divergence of opinions. There's more than one camp at the Fed in terms of the voting members and what they think should be done next. There's like 3 different camps, and I won't go in detail right now about what those camps are, but let me just say that they're not all convinced that the Fed should do the thing, although I will add that this is one of the more dovish cast of voting members of the Fed we've had in years. So the Fed, based on the current voting members in place, is certainly more likely, and maybe that's part of what this could be part of what the market's betting on, and could be part of the reason why the euro has held up so well in spite of all the crap going on. Pardon my French. All the crap going on in Europe. I've heard a question countless times: why is the euro still? The euro is overvalued. Why is the euro still above 130? Why is it still above 125? Why is it still above even 120? Well, at least remember the key thing I always think of when I hear that question is currencies are relative. Currencies are relative. For one, multiple central banks, in this case the Fed and the ECB, pursuing so-called accommodative policy. And one notable mover over the currency market, particularly all the USD pairs, is Fed policy. And right or wrong, there's still a sense of still perception that the Fed could still come through with more quantitative easing. And I'm guessing there's a premium. In other words, there's a premium on the Euro USD on the back of probably still some lingering expectations of more quantitative easing. So I don't think the market has totally ruled out more QE yet, but at least the probability of more QE has dropped a bit on the back of the FOMC meeting minutes released yesterday. And I think that's what's going to that's a big part of, I guess, segueing and moving, looking ahead. that's a big part of what can drive the market this month. Is bets for or against more quantitative easing, and certainly from time to time technicals can come into play. Yeah, I see Gam says shouldn't be as concerned, and if you're referring to stock valuations, I would agree with you. But yeah, we can carry on a lengthy debate on the merits of what not just the Fed and what other central banks are doing. It's a valid one. I mean, I believe I have more than my own share of concerns as well. But one of the things I can even remind myself of is, and I'm not suggesting you feel this way, Gam, but as a trader, and I've seen that several traders in the past, and not just in our classes of boot camp, but even outside the boot camp, even non-traders get all worked up about what governments are doing, or what the Fed is doing, or what President Obama is doing, or what Trichet used to be doing, or what Sarkozy is doing, or what Merkel's saying, whatever. I'm like, yeah, now I don't say you shouldn't care, but as a trader, you can't let your emotions about what a particular politician is doing or not doing affect your goal, your ultimate goal of making money for markets, what you anticipate markets could do. So the next Fed meeting, I think I have my dates right, April 24th and 25th, Tuesday and Wednesday. I believe the last Tuesday and Wednesday of April. And particularly all of the U.S. economic data between now and then could help guide the market as to the prospect or not of more QE. My best guess is if the Fed's going to do more QE, it probably won't happen until June. But I could be wrong. I could totally be wrong on that. I bet but I will say this: the April meeting probably a key one, and we may see clues in the statement from the FOMC in late April, and especially from the minutes 2 weeks after that, if the Fed's going to do more easing in the June meeting, the clues to that will probably emerge from either the statement or the minutes after the meeting later this month. But again, the market will still try as best it can to discount that, to speculate on whether or not the Fed will actually do so. And one of the things it'll derive some speculation from is things like the jobs numbers. We've got the NFP report coming out on Friday, certainly the non-farm payrolls report. That's always shown a long history of moving the market, but I'm sure one thing the market will look for is a continuation of recent improving numbers in the U.S. jobs picture. Oh, Gam, totally. Gam, I'm not even finished my point there, and you make a valid point. I'm just right now. I'm talking about just one of the things that's going to move that can move the Euro USD. So speculation on whether or not the Fed's going to do more QE. Yeah, and that's a totally another part of the picture. What happens in the EU, which could definitely move the market. It's like the market shifted back and forth at times between the Fed, the question about the Fed QE or not QE, and the other question, which is definitely had some notable effect on the euro. Well, again, I just mentioned earlier. Actually, you know what? Maybe I didn't mention this. Sorry if I didn't mention this, but I mentioned in the live class at FX Bootcamp, in our newsroom at FX Bootcamp, we've seen bond yields, Spanish bond yields go up recently. The Spanish 10-year, last I checked, was north of 5.5%. Last time we were at such a level was like earlier this year, and more recently a week ago last Friday. And what's interesting is that this is happening. We also had a bond auction, a Spanish bond auction, which didn't go so well today. Bid to cover ratio is lower than previous auctions, and yields were higher than previous auctions. Yeah, Gam, I'm going to get to that. Well, not just you're talking about the unemployment numbers. The unemployment numbers are going to be twisted because of discouraged workers leaving the counted workforce. And also, Gam, you've got there's been some chatter about the warmer than normal weather this past winter, maybe affecting some of the jobs numbers as well. And I suspect we're going to find out, if not from this March report due out on Friday, but maybe from the April report due out in early May. How legit or not the recent jobs numbers are. And well, I mean, I would also add this: the jobs numbers we are seeing, the reported job growth we are seeing from the Labor Department. A lot of those jobs. I'm going to break this down either today or tomorrow, and I'll present it either on the. In fact, I know I'll present it on our blog at Forex Street, on the bootcamp, the FX Bootcamp blog at Forex Street. But I will also probably discuss this in our newsroom at Bootcamp either on Friday or early next week. But my point is this: with regards to the U.S. jobs picture, a lot of those jobs I haven't quantified yet, but some of my anecdotal research, anecdotal is not the right word, but I've scoured through some of the raw data, and I sense that a great deal of the job creation we have seen in the U.S. in recent months, low-paying jobs, relatively low-paying jobs. I mean, the production of the creation of low-paying jobs better than none, right? But it's for those who see the jobs numbers as jobs are jobs, and no, that's not the case. That's not the case. If you look at, for example, U.S. government tax receipts from February of last year to February of this year, down, even though jobs numbers are up, suggests maybe that the jobs that are being created are lower paying jobs than the ones that are being. Remember, there's a constant churn, folks, of jobs. In fact, if you look at the gross numbers for jobs, they're like 5 million each way. It's like in any given month, like something like 5 million jobs created, like somewhere around 5 million jobs, eliminated or left or something like that. So it's the net change of what the NFP report looks at. But again, back to Gam's comment about the numbers being false. Very valid points about the questioning the likes of the NFP numbers. I mean, there's questions about figures from a lot of different sources, not just the U.S. jobs picture, but I mean, think about some of the data from China that the market reacts to from time to time. Chinese data, a lot of questions from Western economists and Western traders and such about the validity of a lot of the Chinese data. But again, do not get so wrapped up in things like that, because I mean, bottom line, at least for now, that the market can still react to these numbers, even if you have your reasons to believe the numbers are just false. Well, going back to the point that I think Boyke made earlier, you got to, I think what Boyke was implying is that, the ultimate truth is price action, and if price action responds, if the markets respond to certain numbers, regardless of one's theories about how accurate or not they are, then you got to assume more of the same until the market shows you otherwise. So what else am I watching besides signs of continued economic improvement or maybe a change thereof in the U.S. economic picture? It's U.S. and Europe. We have seen some rising concerns about more than a soft landing in China, maybe a harder landing than some expect in China. Got a mixed picture out of China. It's arguably a tough read. I don't know how many of you know when it comes to, say, the China PMI numbers, there's two different sources for the so-called China Purchasing Manager Indexes, which are reported near the beginning of each month, around the beginning of each month. There's an official number, and there's a number compiled by HSBC. The official number reflects more of the health of larger Chinese firms, the Chinese manufacturing firms, that is. The HSBC number reflects more of the health of smaller firms. And the HSBC provided numbers are lower, or still below or still sub 50, suggesting contraction in Chinese manufacturing firms. The official Chinese numbers are higher, suggesting some renewed expansion in the Chinese manufacturing sector. So, since the market's still sorting that story out, the story being is China only going to slow moderately, or is China going to slow more materially, in a more pronounced fashion? And to the degree that the market believes that China will slow more significantly, that could weigh on a currency like the Australian dollar, or even the New Zealand dollar. And we've, of course, some of you have noticed by now, we have had a notable downturn of late, notable compared to what it's done in the past, a notable downturn in the Aussie USD. What the heck? Got a Norton pop up there. So I'm going to go to an Aussie chart. Oh, that chart's a mess. But you could see the point. The trend has definitely been down of late on the Aussie. And some speculation, by the way, in the market that it's only a matter of time at some point this year before the Australian Central Bank, the RBA, does an interest rate cut. So there's a current question mark for the Australian dollar, if there's going to be another rate cut, and if so, when. One guide for there could be look for future references from the Reserve Bank of Australia, the Australian Central Bank, to their to that country's terms of trade. They basically the ratio or difference between export prices, price which Australia sells its goods to foreign customers versus the price it pays for stuff it buys. The so-called terms of trade, and when terms of trade are, if the terms of trade eventually drop materially, then we could see a rate cut eventually by the Australian Central Bank. If terms of trade stabilize and improve, it takes a rate cut increasingly off the table and could eventually lead to further rate hikes. Concern about Australia is I don't know how many of you trade that currency or watch that economy much. It's in some ways kind of comparable to Europe. Australia's got arguably a two-speed economy. There's the mining sector and then there's everything else. The mining sector and everything else. The mining sector benefiting from Asia, particularly China's appetite for commodities. Australia is a commodity-rich country, but then the rest of the economy, like the normal businesses, particularly the retail sector, those sectors are relatively struggling right now, particularly on the back of what's been a strong currency. So weaker currency would definitely help the rest of the Australian economy, and to the degree that we see further slowing in China, if we do see that, then the Australian Central Bank could get more accommodative with their policy, lower rates further. I'm reading Cam's comments about China's headwinds. Yeah, Dr. Copper. It's not a bad idea to monitor what's called Dr. Copper futures, or just simply copper spot prices. Copper, not a bad leading indicator to what's happening in China, although it can be skewed sometimes. Sometimes China will stockpile commodities certain periods of the year. By the way, I can keep going, but I haven't quite run an hour. I'm not a clock watcher per se, but I want to be sensitive to everyone's time here as well. If some of you have obligations to be somewhere else, or maybe if I'm keeping the folks at FX Street around longer than they planned, I don't want to to compromise anyone's schedule, particularly since I'm the one that was late. But I'm happy to keep going if those of you who are here are okay with it. Jose, you're asking about dollar CAD. But first of all, Coco asked the question. Hey, Coco, good to see you again. Coco was a regular attendee at my PAR webinars when I was conducting regular webinars here. Yeah, Coco, maybe I read your question too quickly, but Coco, I will tell you this. Let me find this. I've got a correlation chart I want to show you here. What do I do with it? Here we go. This may be a little hard to see, and my apologies for that. Let me try to zoom in as much as I can without losing it here. This is correlations just for the month of March, and I don't have an accompanying key for this, but let me describe it verbally. Yeah, the Smarties chart. Let me describe this verbally. To show you an example of strong positive correlation. Look at the euro yen and look at the S&P, the euro yen row and the S&P 500 column. That thin blue ellipse, that stands for strong positive correlations. In other words, as the S&P 500 rises, so rises the euro yen. Be careful with assuming that's cause and effect. It's just the two, the price action on the two are associated with each other. That's all the way I like to think of it. So euro yen up or S&P up, euro yen up. Sometimes I think it's the other way around, but that's another point for the topic. So euro yen has been positively correlated over the month of March with the S&P 500. Negatively correlated. By the way, there's an example of negative correlation. That fairly thin red ellipse that my cursor is next to now, euro yen and the euro yen row and the 10-year T-note column, suggests that the euro yen is negatively correlated with the 10-year T-note price, meaning that the euro yen goes up, T-note prices go down, and yields in fact go up. Prices and yields are inversely related there. Here's my point, and I've seen this increasingly, not just in March, but even before that, and even since the start of this month. This month's fairly young, obviously. The U.S. dollar pairs, the U.S. dollar not as well correlated with equity markets, for example, as the yen crosses are. Japanese yen closer correlation with equities and other markets than lately than the USD has been. Now, I don't know if that continues. It very well could, but for now, keep that in mind. Do not strictly assume every day, every session that stocks up, dollar weak, stocks down, dollar strong. It does, that correlation does resurface from time to time, especially on severe moves. We see stocks sharply down, dollar does tend to gain strength. If stocks sharply up, we've seen the dollar weaken, but it's not, the correlation isn't quite as reliable as it was, say, last year. But Coco mentions dollar yen, and by the way, I see some other questions, and I'll get to those other questions as quickly as I can. Coco mentioned the dollar yen. I'm sure I mentioned this before. I'm sure many of you are aware of it too. Dollar yen, a pretty decent guide for the dollar yen in terms of long-term correlation, not intraday or day-to-day necessarily, but longer-term, bigger picture, with daily, weekly chart type correlation. Dollar yen versus the 10-year T-note yield. Keep an eye on that. Let's see the other questions here. Sam, I already discussed that. Where do I see it bouncing the euro? I think the euro just found what could be at least near-term support. Let's call it the 131 area. Trend line, weekly support pivot, monthly support pivot. And who knows, that could be it for the week. Unless we see a really rip-roaring good NFP numbers on a Friday, which could be the catalyst for the dollar to rally further and pull the euro down. Hey, cheers, Sam. glad I helped. But Sam, well, that's fine for today. That's fine for this trading session. But back to the point that was it GAM or one of you made earlier. Yeah, keep an eye on the eurozone. The market's attention right now on the when it comes to the euro USD, and this, of course, this has rub-on effects to other currency pairs like other USD pairs, for example. It seems like the market. It's like watching a tennis match. Some days, sometimes you're focused on what's happening with the U.S. What the Fed might do, the implications for recent U.S. economic data. Another session, or particularly another day, you're focusing on Europe again. You have like say yields in Spain rising or dropping, and you're contemplating the implications for the euro. Well, let's put it another way. as was mentioned earlier, it's not it's not a good idea to ignore Europe. But in terms of one thing I like to think of in terms of what can move the currency market. I mean, as I mentioned earlier, central banking policy, changes in central banking policy, certainly historically a key driver of currency pairs. And if you look at, let me just pose the question. Amongst the major central banks I've mentioned earlier here, the Federal Reserve, the European Central Bank, even the Bank of England, who do you think is going to act first? Who could? Well, just maybe more of a thought experiment there. Who do you think could make the next move? Oh, no worries, Sam. In reference to your comment about being experienced. And that's a question I ask myself, maybe not every day, but close to it. It's kind of like a chess match, isn't it? Who is going to make the next move? When you define an answer to that question, or if you can't figure out an answer to that question, maybe that gives you some homework to do. Do some research on the so-called fundies, or maybe look at charts. Maybe there's some answers there. The answers in the charts could be in the form of recent price action could suggest increasing speculation towards one particular move or outcome by one central bank over another. My best guess is this: right now the market's speculating that the Fed's going to make the next move. So that's why I would guess. I mean, there's still going to be those sessions, the days when the euro is moving on the back of maybe news flow out of Europe, but I would guess there's the predominant question for this second quarter of 2012. The predominant question is probably, I stress the word probably, is going to be what the Fed's going to do next. Now, I still got my eye on things in Europe. For example, there's French elections later this month. And what's notable is that if Sarkozy loses his job, and we get somebody else in office, I'm curious to see what that new president, if elected, does with regards to the fiscal pact that Sarkozy agreed to, with regards to what the other Eurozone countries agreed to in terms of fiscal discipline there. Yeah, it can be a moving target in response to Sam's comment about what's moving the market. I mean, again, I go back to the point I made earlier, and I know at the risk of repeating myself, and getting to the point where, okay, guys, I already know this, you're hearing it over and over again, but you can say repetition is the mother of learning, and I'm still reminding myself of this as well. One of the challenges of the markets these days is that, and one of the reasons you can argue, if I go back to the euro charts, and hopefully I find a chart here that doesn't have so many lines on it. I think I've already failed here, because this chart has more than a few lines on it. I'm going to go to a weekly chart. Okay, this isn't terrible. I actually drop some of this stuff. Okay, the point I was going to make is this: you can, depending on how far back you look on the Euro USD, I mean, look at the lines in the middle of my chart. It's almost like this 131 to 133 area. It's almost like a center of gravity for the euro over the past 2 years, maybe even more if you zoom out enough, but especially over the past 2 years. And the point being this, the market I suspect is still struggling with this idea of again multiple central banks all doing sort of the same thing here. And again, there's some notable exceptions certainly. The Australian Central Bank, as we mentioned earlier, looking to cut rates and trailing behind what other central banks have already done. But again, the question that I'm stressing here is. Or the point I'm stressing here is that a lot of central banks have pursued very accommodative policies, and the major ones, especially the Fed, the ECB, the Bank of England. And the question, at least in terms of those three central banks, is who makes the next move, and particularly over time, who's going to start undoing this accommodative policy, start raising rates, start undoing some of those quantitative easing programs they put in place. And I'll tell you what, one for the very long-term future. I think if you can hang around long enough for this and survive as a trader and hopefully thrive as a trader by then, boy, can you imagine? I'm imagining I'll get my dates right here. The end of 2014. If we get past the Mayan calendar threat of December of this year, and if we see the actual Earth, the third rock from the sun, continue to spin without any disruption in the poles or something like that after the end of this year, then it'll be interesting to see what transpires around the end of 2014. Now, why the end of 2014? Well, that's when the first batch of LTROs distributed by the ECB in late December. That's when they're due for repayment. Yeah, see the currency wars reference by Arsene. That's a pretty good read. It is. I agree. I've read it too, and it's a good read. So I don't know if I've done this hour justice, but I hope I've helped. And by the way, I'm still here. I'm not looking to leave that quickly, but if there's a pressing question or just a comment you really want to make sure that I see, post it again. If you have another comment or a question you posed earlier that I did not address, I'd be happy to address it. It can be technical. I do have some knack for technicals. I still consider, among others, one of our currency coaches at FX Bootcamp, namely David Pegler. I consider him world class in terms of technicals. I always, I think I hold my own just fine, but he's the master in technicals, and he's certainly done his share of webinars here at FX Street. But if you do have more of a technical question, I feel like I can address it. One thing I haven't mentioned yet was, and the dilemma the ECB faces is, I mentioned earlier the so-called two-speed economy in Australia. You have the same thing going on in Europe right now, and I'm sure those of you who are based in Europe are more than well aware of that. The peripheral countries pursuing the so-called austerity measures, cutting government spending, some wages in several countries need to drop some. And what those countries really need is a devaluation of the common currency or a lowering of rates or a combination of both. They're just not getting it right now. And one reason increasingly they may not get it is if you look at the so-called core of Europe, led by Germany. Germany faring, not great, but fairly well, all things considered. In fact, there's actually signs of, by different measures of inflation perking up a little bit in Germany. Just been reading recently about some wage deals for German workers. German wages, if I read this correctly, have been rising on average about 2% year to year over much of the prior decade. Well, there's I think one major union in Germany just agreed to a wage increase, the likes of which we haven't seen in Germany in about 10 or 20 years. Oh, and something else I mentioned in our live class at Bootcamp, there's been some new buoyancy to German residential housing prices. And that's going to make the job of the likes of Mario Draghi, the ECB president, really challenging. To juggle monetary policy for a region, namely the Eurozone, that has very different economies with very different distinct problems or strengths. Yeah, so if you're right, if Germany does, well, it's needless to say, it's going to be interesting times. It's relatively speaking, volatility is. By the way, I was about to say relatively speaking, volatility is down. Have you seen my the volatility? Graph on the Euro-USD that I posted just yesterday. Let me dig that up. So some of you are keenly with this of the dropping volatility on the euro lately. Actually, I got a couple of them here. There's one. This is a 20-day moving average of daily range. So what I do is I take a snapshot in time for each of the days going back to, summer of 2008. So you look at each group of 20 consecutive trading days. Look at the high and low for the Euro USD for each day. So take high and low for day one, what's the difference in pips? High and low for day two on the Euro USD, what's the difference in pips? And you get 20 different numbers, 20 different counts in pip terms. Take the average of those numbers, you get each individual point on this line chart, this blue line. And through Monday, through April 2nd, through Monday, the 20 so as of Tuesday, you might say, the 20 prior trading days on the Euro USD, the average range for the euro has been 111 pips. And the point being, the broad trend has been down, certainly as of late. But then, notice the times when it's perked up. I mean, it's perked up at times you might expect it to perk up, namely the original Greek sovereign debt crisis as it unfolded in spring of 2010. The euro spiked. The euro saw a lot more volatility. The euro's seen volatility as we've had some so-called aftershocks. But it's low now. But these are relatively. This is you could argue, and I think rightfully so. This could be the calm before the next storm. Now, there's no promise there. Volatility could remain lower for a lot longer than any of us would like. But I will say this, in spite of somewhat relatively low volatility of late, I still see the euro as very tradable and responding to some historic technical levels fairly well. There's still pips to be made in this relatively lower volatility environment. I don't know about you guys, or you folks, but I recall trading the euro back just before I became a currency coach at FX Bootcamp. I remember days when the euro would barely eke out 70 or even 65 pips per day, and we still found some ways to make money. It was a little tougher work, I admit, and involved many days a lot more patience than one would like to put into practice. But there's still money to be made. Oh, by the way, so that's a look at overall euro volatility. I also have a graphic which I put recently on the Forex Street blog about volatility by session. Anyone seen this? Or anyone in some way aware of this? This shows the 20-day moving average of not yet, Boyke. I'm going to get to that. I will post that hopefully very soon on our blog at forexstreet.net. Yeah, I don't have that ready, but I'll have that very soon. It actually won't take me that long to whip up, but I've just been pulled in some other directions and doing some other number crunching analyses for our newsroom and for other different reports. So that's just one I have looked at. I mean, I'm really using the Euro USD as a proxy. I'll tell you this. Cable has historically been the one that's moved better in the in the London session than in the New York session. If there's one pair that's shown more volatility than others in the London session, it has the cable. But I started with the Euro USD, arguably a proxy for the broader currency market. Yeah, some of that's to be expected, but GAM, that hasn't always been the case. It has not always been the case that historically London has been where it's at for many currency pairs. So I hope those of you who have the means and the schedule flexibility to do so, hope you're looking for some more sufficient trades during the New York morning session, because by and large that's where the volatility has been. I mean, I'm not saying London isn't tradable. It's quite tradable. It's just that in my perception, the data kind of proves this out, that we've seen, do the math there. On average, 20% more pips to be had on the Euro USD during New York session than during London session. Sam Shale asked about a volatility index. Boy, I'm drawing a blank there. I don't recall one. And maybe is there like an ETF for that or something? Don't know. And Sam, I'm not. I've heard of that one. I haven't looked into it, quite frankly. Sorry, I can't help you much on that, but I just haven't had the time to look into something like that. It's a valid question. At this point, I simply do the. I just simply look for clues from other markets. I know the tendency, and I'm as much desire this sort of thing as anyone else. Looking for that single indicator, that single thing to look at for risk on and risk off, almost like a green light, red light sort of thing. I guess I'm a little more of an artist in that fashion. I tend to look at multiple indicators and prefer to see that multiple things are flashing green or multiple things are flashing red. And I understand that that's for some traders, for some people that's a little too much, a little too confusing. Probably chalk that up to my my background as a so-called quant. I mean, I'm so used to looking at multiple different metrics or indicators, or call them what you want. Very accustomed to processing multiple types of data and driving conclusions from that. So, but yeah, for those looking for something more of a singular measure, I'm not aware of one. You be careful with that. You got to be careful with that. Such things can be helpful, but you lose a level of granularity, which leaves it prone in some conditions to false signals. Yeah, so I agree that, and not, by the way, not everyone agrees with this, Sam, about the trading as an art thing. And folks, if trading doesn't feel like an art yet, all I can say is you got to give it time. In terms of what I call reading the charts, reading the markets, folks, it took a lot of time and my share of pain and lost pips and frustration, banging hands against the wall and and tear up a lucky hat I used to have or whatever. It's taken time. It's taken time. So if you're let me put this another way. If you have the discipline and the patience and give this time, that is trading, and can weather your way through this current market, when, as I said earlier, there's all kinds of central banks doing all kinds of somewhat funky and creative things themselves, and there's plenty of uncertainty about what's going to happen next. Is another shoe going to drop in the Eurozone? What's the Fed going to do next? Is the U.S. economy really recovering or not? Plenty of questions being that even the smartest people, the so-called smartest people, there's some people who've been at this a lot longer than any of us have, economists or traders or investors, who even some of them, although some of them posed a more confident demeanor when interviewed, say, on TV or maybe some of their writing, I know there's more than a few traders or more than a few fundamentals are like, I don't know what the crap's going to happen next. I have a rough idea, but I'm not sure yet. And so what some of these, I think what some of these money managers or traders are doing is that there's certainly probably a fair share of hedging going on. They're making a bet about one outcome, but if they're wrong, they're hedging that bet with another position. And maybe I'll tell you what. One thing that has helped me, not just like really recently, but I've been doing this for a while. But I feel like one thing that's been extremely, not extremely, but it's been even more important lately than it has been maybe in months and years past, assessment of relative strength analysis. It can really make a difference to one's trading day. Identification of which currencies are relatively strong, which currencies are relatively weak, and picking the right horse. For most of us, not all of us, and I don't say it should always be this way, but most of us, most of our trades anyway, are based on a USD pair, or a Japanese yen cross. Now, I know plenty of traders, and I take some of these trades from time to time, traders taking trades on other crosses like, I don't know, a pound Aussie or a pound CAD or a Euro CAD or a Euro Aussie. There's trades to be had on some of those pairs, no question. But the more liquid pairs, the more heavily traded pairs, and the pairs that still to this day offer enough decent volatility, most pairs involve the USD or the Japanese yen. And what's the point? Oh, so the point I was getting at was this. One of the first things that we'll do each day is assess, okay, what's moving? Is the dollar moving? Is the yen moving? Is the dollar strong? Is the yen strong? Do I have reasons to believe the dollar is going to continue to be strong or weak, wherever the case? Do I have reasons to believe the Japanese yen is going to continue to be strong or weak, wherever the case? Once I figured that out, or right or wrong, once I've decided on a bias for against the dollar, for against the yen, and by the way, the bias could be neutral. You could decide that I don't know what the yen's doing. The yen doesn't know what it's doing. I wait until the market figures it out. That is a viable bias. Don't forget that. And being neutral on a currency or currency pair is a very, very viable position or bias. But once you've figured out that you have a bias on a particular currency, like a dollar or a yen, it's like then the challenge is to figure out, what can you pair it up? What are you going to pair it up with? I still know a lot. I saw it, hear about it from a lot of traders. One close relative of mine, I'll name him by name, but it's my brother. My brother is a very regular Euro USD trader, and I can always tell the days he has a tough time as the days when the Euro is sort of struggling, but something else is moving. And he talks about, on those days he's talking about, this Euro just sucks today, and it's a challenge to trade, and yada yada yada. When if you look at across the rest of the currency market, that was a day when, say for example, the yens were rip roaring. The yen was rip roaring strong, of course, based on more recent price action. The yen has been broadly weak, and that's when I posed the question to him. Well, why are you trading the Euro USD on a day like this? And the answer from a lot of traders, and I can understand this, is that they like to focus on one pair or a very limited subset of pairs. That's fine. That's totally fine if you are newer to trading. But I believe eventually you want to get to the point where you expand your repertoire a bit. You have multiple options and can reliably assess. Do a relative strength assessment, and then in other words, just be able to sense and read from reading the charts what's moving and trade what's moving. Now, I know there's plenty of traders I believe that go through days or sessions of frustration because they're simply trading what's not moving or trading based on what relative strength you can reasonably expect not to move. Remember, what we're looking for traders is we're trading currency pairs. Well, operative word there is pairs. You want to trade a pair where either one currency is moving and the other one's neutral. So for example, you want a pair where one currency is strong, the other one's neutral, or a currency is strong and the other currency is weak, or one currency is weak and the other one neutral. You don't want strong versus strong. You don't want weak versus weak, and sometimes that happens. Yeah, and I agree, Arsene, totally agree that being a more dynamic like that does take time. Yeah, I see Sam's comment about don't return to neutral fast enough. Yeah, true. That's why I think if you're talking about, Sam, you're talking about like, knowing when to take profit or not? Because I'll admit that daily range analysis can help somewhat with that. Pivot points, again, helpful with that too. Boyke, one way I do that, and I'm going to have to wrap it up soon. I'm sorry I had to wrap it up soon. I wanted to run extra overtime here, longer than 1 hour because of my tardiness. And again, I apologize again for being late. I'm sorry if we had the problems earlier. Boyke, one way I do that, it's not the only way, but one way I do that is a view like this. Yen crosses. Top row, Aussie yen and CAD yen. Bottom row, Euro yen and pound yen. Now, today wasn't a good example of that because today the yen was broadly strong and strong enough such that it was hard to identify which of these so-called base currencies were uniquely strong or uniquely weak. A little more difficult today, but I've seen even on days when we've had some recent days, particularly last month, when the yen was broadly weak. We've been a recent rally of broad yen weakness. Even on days like that, you can get a sense of what stands out. Well, I'll tell you right here. Let me zoom out a little bit. Maybe we can tease out some themes here. Unfortunately, I don't have a drawing tool, so I can't walk through this in a manner I'd like to do it. But here's what I see. If I had to pick which one of these charts stands out the most, actually, Sam, I'll let Boyke ask a question. I'll let Boyke guess. And by the way, anyone else, feel free to guess as well. If there was one of these charts, I'm looking particularly at recent price action. If one of these charts stands out the most, which do you think it is? I have my eye on one particular chart, especially recent price action. I'm talking about the past few hours of price action. These are all 15-minute charts. To me, one chart stands out a little more than the rest in terms of very recent price action. Yes, Boyke, that's the one. That's exactly the one I was thinking of, pound yen. We've seen broad strength in the British pound, and it's given a more of a notable lift to the pound yen than the rise seen in the other yen crosses. And by the way, we talked about the possibility of that. And Boyke, I don't know how much you use this pair, but a pretty decent guide or proxy for the British pound. Can anyone tell me what that is? I'm asking because maybe some of you heard me talk about this particular pair in the past. It's not the pound yen, by the way. There's one currency pair that I consider a pretty decent guide or proxy to the British pound. And I'm not the only one who thinks this. I've seen other references from other sources. Actually, there was a reference to this in, I think, on a blog in the Financial Times. Anyone know the pair I'm referring to? Let me go to the British pound pairs. No, it's not that. Although pound Swissy is not bad. Pound Swissy I see as more of a pure play on the British pound in case other things are going on that you don't like. But Arsene's got it. Arsene's got it. Euro pound. Not always, but often enough anyway. As the euro pound goes, so goes the British pound. Now it's been it's admittedly been more complicated. It was especially more complicated last year because you saw the euro pound last year drop on the back more of euro weakness than British pound strength. Although you can argue it's kind of a combination of both because if you think about the euro pound dropping on the back of concerns about the sovereign debt crisis in Europe, but what happens when, say, British investors are concerned about Europe, or British, consumers, corporations, whatever, have money deposited in European banks? Well, some of that money may have been brought back into Great Britain, and that could be part of the reason why you're seeing some pound strength, or what saw some pound strength last year against the euro. But anyway, my correlation studies have fairly consistently shown that as the euro pound goes, so goes the British pound. In other words, very often the euro pound down, British pound broadly strong, euro pound up, British pound broadly weak. Yeah, it's not perfect. Don't bet your favorite goat on that, but that's it's pretty decent correlation. And really, at these levels that we're at, like really right now, it's not by no means a trade call, but this is a very interesting area for the euro pound. Look at these recent lows. In fact, almost all several of the lows established this year, since about mid-January, several lows established at or very close to this horizontal blue line at about 82.70. So I mean, so you have a decision here, and you can actually wait for price action over the course of the rest of the New York trading day, or especially over the rest of over the next Asian session, maybe even part of the next London session. Dictate this, but I wouldn't be surprised if at least tomorrow, maybe Friday and a little bit beyond, the sentiment for or against the British pound could depend in large part on the ability or lack thereof for the euro pound to break this 82, call it 82.70 area. Maud, no. Maud, I was just getting going. Maud, I've got like a third wind going here. No, Maud, seriously, I know I've been running way over time, but I guess I was feeding off the comments and questions I got in here, which I really appreciate. And I felt bad for being late, so I wanted to put in my fair share of overtime to help make up for that. But yeah, you're right. It is. I've probably run my course. I'll tell you what. I will. Hopefully, I'll get a follow-up email from Vicky at FX Street, or maybe even Maud, and we'll do this again soon. I don't know exactly when. Maybe sometime later this month, maybe next month, whatever the case. But I'll be back. I'll be back. Yeah, Sam, I will do my best to come back. Again, my schedule. Well, I changed my schedule here, I changed my role here at Bootcamp a little bit. I'm covering what's called our newsroom at Bootcamp, so that involves a lot of extra preparatory work, a lot of extra research, and some really odd hours in terms of market coverage. So my sleep schedule, my personal schedule is really out of whack right now, or has been, but it's getting better, and I'm kind of picking my spots and managing my schedule a little better right now, so I can hopefully have more flexibility over time to do more of these events at FX Street. And by the way, I do love doing this. I really enjoy doing these events at FX Street. Sometimes even more so than even the coaching to boot camp, because the folks that attend here bring a lot of passion, bring a lot of good comments, good questions, and I'll tell you what, as a presenter, that's really energizing. Really enjoyed that. So again, thanks again to Maud and everyone else at FX Street. Thank you again for your patience as you awaited my arrival. I'm glad I finally made it. And again, I hope I'm invited back in spite of my tardiness today. Enjoyed it, and I hope to do it again soon. Take care, folks. Cheers.